Traditional hardware manufacturers are currently bracing for a severe slowdown. Consumer demand for smartphones and PCs is softening, and rising geopolitical tensions are complicating the global supply chain. This chart shows Goldman Sachs' price targets and ratings for TSMC. While the rest of the sector faces headwinds, analysts at Goldman and Morgan Stanley are raising their price targets for TSMC to record highs. This disconnect is caused by the AI offset. The demand for artificial intelligence hardware is now large enough to fill the revenue gap left by the slowing consumer tech market. TSMC is using this surge in AI demand to decouple its growth from the rest of the struggling hardware industry. To secure this massive lead, TSMC is planning a projected $200 billion capital expenditure through 2028. This aggressive spending plan is a deliberate strategy to build a financial barrier around their market share that no rival can afford to cross. TSMC is proving that an AI monopoly is physically built. Even the most advanced software models are ultimately limited by the manufacturing capacity of the one company that can actually build the chips. To see what $200 billion actually buys, we have to look inside the fabrication plants themselves. Deploying this much capital requires constructing massive, hyper-sterile environments designed for precision manufacturing. A significant portion of this investment funds the active transition from 5-nanometer nodes to the more advanced 3-nanometer architecture. By 2028, this spending will further accelerate the ramp-up of the next-generation 2-nanometer and A14 nodes. This chart shows the result of that relentless spending. TSMC now captures over 60% of the global leading-edge foundry market, leaving only a fraction for its competitors. Leading-edge chip fabrication is now a capital intensity race that TSMC has already won. The second major investment pillar is a packaging technology known as CoWoS, or chip-on-wafer-on-substrate. Printing the silicon is just the first step. For artificial intelligence, chips must be stacked and connected in specific ways to achieve required data speeds. TSMC is rapidly expanding CoWoS capacity to meet data center demand, driving massive volume increases. Because AI accelerators depend on this specific packaging, TSMC controls a critical choke point for the entire global AI supply chain. Samsung and Intel have struggled to replicate this dominance, and the reason is not just a gap in laboratory science, it is a deficit in financial firepower. TSMC's rivals currently lack the capital to match this level of infrastructure investment. Building and scaling the clean rooms required for 2-nanometer production takes years of specialized execution. A competitor trying to catch up would need to deploy hundreds of billions of dollars immediately, making TSMC's current lead structurally uncatchable. This physical moat is creating a permanent shift in TSMC's profitability. This line graph plots TSMC's projected gross margins through 2028. Driven by AI pricing power and internal productivity, margins are expected to reach 66.5%. TSMC is now extracting more profit from every piece of silicon it produces than at any other point in its history. This chart shows the target price history for TSMC's American depository receipts. Despite the recent stock climb, analysts still project significant upside. Long-term corporate revenue is projected to grow at a compound annual rate of 25%. Within that revenue, AI semiconductor production specifically is expanding at a compound annual growth rate of 55%. Even with its monopoly on the AI future, the stock currently trades below its 5-year average price-to-earnings ratio. The AI revolution rests on the $200 billion physical foundation that TSMC is building. Right now, it is the only factory in town.